Good afternoon, everyone. This is Mark Masterson, partner and managing director at HighTower Naples. Happy New Year. I am bringing you our year-end and first quarter 2017 commentary, video commentary and analysis, outlook as well. We have a great deal to cover. So as usual, we like to keep it to 20 minutes or so. So let's go ahead and get started. We'll begin with our usual, the four horsemen. And our four horsemen include fundamentals, taking a look at fundamentals, technical analysis, sentiment around markets and asset classes, and of course, policy. If you saw our post-election video commentary, you know that we did make a few changes. Some things had been changed based on the election results, and primarily those can be seen right here in the fundamentals. We changed it from a negative to a neutral, and the reason we did that is not because growth is going to accelerate immediately, but we do believe that change is in the wind, and we're going to be moving from what has been a sluggish 1.5% to 2%, what I would call kind of a bad economy. It's not terrible, of course. We're not recessionary. It's been fine. But growth has been very sluggish, and it's been sluggish for some time. We're going to be moving from that quote-unquote bad economy to a less bad economy. So the Trump administration and some of their policies, I think over the next 12 months are going to be much more pro-growth. We're going to see that shift from 2% to maybe 3.5%. We're not going to get 5 or 6% GDP. It's not a miracle worker, but I do think that's going to improve. And with that, we'll improve the technical picture, although the technical picture still looks pretty solid from our standpoint. Sentiment's a bit too bullish, which is why we show it as negative. We think folks are a little bit too optimistic. Maybe they're assuming everything will get done. I don't think that's going to happen. And of course on policy, fiscal and monetary. We're neutral because here in the U.S., the Fed is still embarking on a very slow tightening cycle. So that hawkish position is very different from the rest of the global central bank position, and that's going to create headwinds. However, we are going to potentially see some fiscal policy changes that will be more pro-growth. So again, we're going to stick with a somewhat neutral position, feeling okay with things, and we're going to go ahead and move on from the four horsemen in a more positive way. Let's look at Trump's first 100 days. Lots to be discussed here. He did outline early in his or later in the actual campaign, his 100-day pledge. And he talked about things that he wanted to get done. So if we take a look at those, I think this batch here will all get done pretty quickly. And that's going to include some tax cuts, including cutting the corporate tax rate. It's going to include rolling back some regulation. Deregulation is going to be a very pro-growth, pro-business environment. We're going to have the oil patch and some of the infrastructure projects probably be unlocked. And we're going to see a change to Obamacare, whether it's a repeal, a replacement, we don't know yet. But that's going to take shape, and that's going to be worked on very, very early in the administration. We're also going to have a number of other things, but how quickly they get addressed is unknown. That includes the immigration policy and changes. It includes military spending and security spending. And of course, it includes the quote-unquote $1 trillion of infrastructure spending that has been promised. We don't know what that's going to look like, when it's going to get done. It's going to be talked about. But I believe this portion up here above this brown line will all get done pretty quickly, will be pro-growth, and will be a boost early on. In our post-election commentary, we talked about some of the changes that the Trump administration would potentially usher in. And we see, of course, moving from a QE and monetary policy-driven economy more towards a fiscal policy-driven economy, possibly with some deficit spending. Deflationary and slow growth moving towards inflationary and higher growth. Equity market leadership changing more towards real assets and industrials, financials, materials, commodities, defense, and a lower interest rate towards a higher interest rate environment. So what are the challenges ahead? We don't think it's going to be smooth sailing. Let's look at a few of the possible challenges. Of course, on the infrastructure spending, when will it arrive? How's it going to be paid for? We don't know those things yet. And, given the large amount of debt that we have here in the U.S. at nearly $20 trillion, I believe that some of the more hawkish Republicans will probably balk at just trying to spend $1 trillion. So that's going to be interesting to see how that unfolds, and I think that's going to take a little more time. We know stronger dollar potentially is a big headwind for growth. So how are we going to reconcile that? Trade deals and possible trade war, and what's going to be the impact, and is that going to be a counterbalance to the growth that we'll see in tax cuts and deregulation? Those two may not work well together. Potential rising in inflation, again dovetailing with higher interest rates, and debt, again coming back to spending. So we know that President Trump is a real estate guy. He's comfortable with debt and leverage, no problem with that. But who's going to buy the Treasury debt? If we're going to have to do some deficit spending on that $1 trillion of infrastructure spending, who's going to do it? How are we going to get the Fed involved? Are we going to have to do more QE? So, a lot of people are comparing Trump and Reagan, and I think rightly so, because Trump certainly looks like he is adopting the same game plan that Reagan did. But there's a very different backdrop today versus when Reagan took office, and this chart kind of outlines that. President Reagan had lots of runway when he started. He had high inflation, so that could only go down. We had high yields that could only drop. Stocks were cheap, 7.1 S&P price to earnings ratio. Government debt to GDP was at 31%. How about Trump? Inflation's very low, likely more going higher. Rates are low, likely going higher. The PE is expensive. We'll talk about that later. Stocks aren't cheap here. And so, again, there's less runway. And of course, debt to GDP is at 105%. So it's a very different dynamic. I don't think it's an easy comparison. And that's why I think those that are expecting a Reagan-esque 6% GDP are probably going to be disappointed. But those that think that he'll fail will likely be disappointed as well. And we'll probably see a bad to less bad environment, 2% GDP, maybe move it up to 3.5%. Nothing wrong with that when you've been dealing with a slow growth world. So let's take a quick look at some of the fundamentals. As we talked about, growth has been slow. We highlight that here. This is quarterly GDP. It's been very, very weak. Going all the way back to 2014 when QE ended, we've really been 2% to sub 2% for quarter after quarter after quarter. Now, I added manually here that the 2016 third quarter was solid. And we would expect that to slowly rise and see, again, rise into the 3% range and try to stay above that, which would be about this brown line here. So we want to see, Trump's goal is to try to get, the Trump administration would like to see GDP level off more in this range versus as it has been down here. We are seeing inflation expectations and actual inflation rising. So you can see that here where we have in the U.S., inflation expectations have really been rising. German inflation has been on the rise. Euro area inflation has been on the rise. We're really seeing a rise in inflation around the world slowly because, again, we're starting from a very low bar there. Jobs have continued to decline. We talked about this in our last commentary. We've been seeing the jobless rate declining. I would have to say it's about as good as it's going to get. This may be a headwind for Trump, in the Trump administration, that it's going to be hard to improve on where we are. But perhaps what we try to do is improve on quality jobs. Maybe the Trump administration will try to increase manufacturing jobs rather than service or part-time. So those will be some of the areas we'll have to see this evolve. And this may be an early headwind to him and his administration as we move through 2017. And the central banks, we're not going to talk a lot about them, but we are going to point out a few things. One, the Fed is pushing on a string here. They are way out an outlier. If you look at what almost all of the other major central banks are doing, they're cutting. They're cutting. They're doing QE. And here we are in the U.S. with the Fed hiking rates. They did it again in December, and they're talking about signaled for 3 rate hikes in 2017. On the global scene, we're seeing balance sheets. So here is the Fed's balance sheet in white. You can see they stopped doing QE and the Fed's balance sheet has leveled off. But Look at the Bank of Japan. They're ramping up their QE. The ECB is ramping up their QE. They're expanding their balance sheets. And all of that eventually will put pressure on the U.S. dollar as the yen and the euro have declined. It's going to be very interesting to see how the Fed can handle that, and at what point does the Fed blink and possibly look to be forced, if you will, their hand to do a little more support instead of being more on the hawkish side. Here we highlight debt, and the title of the slide, how long till the Fed does another QE? Well, right now they're certainly not talking about QE, but with debt now over 225% of GDP, when you factor in state and local, household and federal, as well as business, rates rising, and again, if we are in a rising rate environment, rates rising will start to put some pressure there. So, the Fed may have to, again, look at keeping rates and boxing rates in a little bit rather than letting them rise. And one of the ways they do that is cutting their Fed funds rate, and the other is through QE. So let's jump in and take a look at specifics, asset classes, stocks, bonds, things of that nature, and talk a little bit about our outlook. The equity markets have been on a tear since the election. Those of you who follow our work, you know that we believe that this rise is essentially justified on the potential for greater growth. The challenge we've had is it was an awful quick move, really got stretched, and there's extremes everywhere. And perhaps the markets have priced in maybe a little too much perfection too soon. And so when we look at where we are, we see this is the S&P 500. You see this big rise. We're kind of leveling off here. You can see we're overbought. Our view is that it probably will work its way back down. Maybe it just tests this breakout and then heads higher, or maybe it really scares everybody and heads down here and then heads higher. Ultimately, we think that we'll be looking for this to kind of work its way back down, looking for the market to be a little less overbought. And frankly, as we look at 2017 and the potential for growth, it'll be a buying opportunity if that happens. This next slide shows the S&P 500 as well, but this is a weekly view, and you can see the same thing. You can see the market just went sideways for a long time. This is 2014, and we were just in this really tight range. And it did. It finally broke out. It broke out, and then it retested. And then after the election, it really took off. But again, we're kind of a little overbought here. We're a little overbought here. This is a weekly chart, so this is a little slower moving than the daily chart. But it would not shock us to see this kind of work its way back down over the coming weeks and retest a little bit lower level. Let this work off some of the excess, this work off some of the excess, and then have maybe a more prolonged, meaningful rise. This chart is one that we shared a while back, but it does show that we were getting a lot of questions from clients ahead of the election as to what to expect from the market. And again, you got to understand, most clients and frankly most experts, quote unquote analysts, were pretty negative heading into the election, thinking that of course if Trump were to win, stocks would really tank. Well, of course that hasn't happened. And in fact, when you look at the results, Strategists did this chart, and they looked at market returns based on administrations, whether Republican control, etc. And the market returns have actually been very, very strong historically during the few times that we've had Republican control of the government. So, that may be a positive omen here for the markets in the coming years. I also showed you this chart. This is a logarithmic look at the S&P 500, but it does highlight how the market had kind of paused for some time and then really took off, paused and then took off. Well, you can see the market really went sideways for a long time. We've kind of broken out here. I'd love to see, again, maybe it come back and test a little bit more of that range before it really takes off. We'll have to see. That doesn't have to happen. But, history could be repeating itself here with this long, decade-long plus sideways grind and then a more positive upward breakout for the markets. Having said that, here are the headwinds. We talked a little bit earlier in the Four Horsemen about sentiment. Sentiment is overheated by most measures that we see. These, I'll just run you through a number of them. Of course, we have the dreaded Barron's cover. get ready for Dow 20,000. Of course, ever since that came out, Dow hasn't reached 20,000 yet. I think eventually, of course, it will. But the Barron's cover tends to be kind of oftentimes anyway, a signal of a move that has already taken place, and we may have to have a consolidation. Sentiment Trader has been posting a lot of their sentiment measures showing extreme optimism. So you can see when their measures combined hit these kind of levels in the past, it's usually meant that the market went sideways to lower for a period of time. And of course, this chart I've showed you in the morning roundup many times, and it shows the quote-unquote smart money and quote-unquote dumb money. And that's just looking at institutional traders versus retail traders. And the retail traders are excessively optimistic while institutional traders remain cautious here. So, sentiment remains a little bit exuberant. We can see that as well in other metrics. We see that in corporations. We're seeing a lot of selling going on from insiders. We're seeing investors fleeing any type of bearish or hedging protection. And of course, sentiment is very, very hot relative to where it's been historically. So a lot of extreme optimism being reflected in the current move of the market. Doesn't mean the current move is wrong. In fact, we do think that the markets will have a good 2017. It just means maybe it got a little bit ahead of itself, needs to consolidate, correct, pull back a bit, and then continue higher. That's our base case at this point. Valuations. In the roundup earlier this week, I highlighted valuations and how they look a little bit expensive. Depends on how you want to look at them. And I will be the first to tell you that there's no perfect way to judge whether stocks are expensive or cheap. There's a lot of different ways to view it. Here's one. This is from JP Morgan, and it shows Wall Street's favorite, which is looking at price to earnings using a forward-looking earnings estimates. And using that metric, you'd say stocks are pretty fairly valued here. Maybe a little bit expensive, but here we're looking at a 17-time PE. Well, at the peak in October of 2007, it was at 16. And then, of course, in March of 2000, it was at 27. So you'd have to say, based on forward-looking earnings, 17 PE. Yes, it's a little expensive versus the average of 15.5, but not overly so. And you can see the same thing in the next chart when you look at the broad market, and you can see the different tops. So moving on from that, let's look at stock market cap as a percentage of GDP. This one looks a little different to me. Not quite as attractive, frankly. This compares the market cap of all the stocks to U.S. stocks, I should say, to GDP. And you can see in 2000 we were at 202%. In 2007 we were 181, and today we're at 196. So is there room to go higher? Sure, but when you look back historically back here, we're looking pretty expensive relative to anything historically based on that metric. This is another, and this looks at averages of Crestmont PE, cyclical PE, Q ratio. Now, there's others too. There's the Schiller, etc. They're all expensive, frankly. Stocks are expensive on all of those metrics, including this one. You can see we're at 77 here. Of course, we aren't anywhere near where we were in 2000, but relative to other market tops and other periods of expensive 1930s, we were at 78. We're at 77 now. So again, valuations aren't cheap. Stocks aren't bargains here. Doesn't mean they can't grind higher, though, especially if we start to see some growth. But it's something we need to keep an eye on and things we need to watch. And we look at a lot of different things when we gauge how much as a percentage we want to have in clients' portfolios and equities. So I'm just sharing with you both sides of the equation. This chart just shows another pattern for the Dow that I've been watching that shows, we're kind of pressing here. It's way overbought. And I would not be shocked, and we talked about this earlier, see the Dow kind of pull back a little bit and take a breather. Let's look at bonds. Lots of talk on bonds. Most of the bond experts we follow are saying now that the bond bull market is likely over. The evidence isn't completely conclusive there, of course, but we certainly have to say if we're going to see more growth, if we're going to see more inflation, we're probably going to see rising interest rates, which are not good for the bond bull market. This chart shows yields. This is the 10-year Treasury yield. And the reason why I show this is because technically speaking, we're actually pulling back from here, which was good for bonds. You can see this goes all the way back to the 80s. For the bond bull market to end, we need to see breakouts here. The yields need to really rise out of this downtrend, and so far they have not. So technically, the bond bull market's still in place. Just it may be dying a slow death, but it's still in place. This is the same thing. This is TLT, which is just the 20-year Treasury, and you can see this uptrend that goes all the way back to 07 still in place. Bonds are actually rallying here, and they're so oversold. I wouldn't be surprised to see a nice rally. The question's going to come, what happens then? Do bonds simply rally up a bit, kind of work off this oversold, get overbought again, and then finally break down out of that? If that's the case, then the bond bull market is dead, and we need to move on there. But so far, I will tell you that's not conclusive. None of it's conclusive yet. It's outside of the fact that bonds have suffered certainly a tough couple of months since the election. Sentiment is extremely bearish on bonds. These are just a couple of charts that show you that we're about as oversold on bonds as we've ever been. So there's certainly room for bonds to rally here. Here's another view of the same thing, showing 10-year Treasury optics over the last 3 years. We're about as oversold as we've been in a long time. And as a positive note to bonds, I will tell you, the commercial banks are very long treasuries here. They are loading up on treasuries at the same time as the momentum traders are loading up on shorts. So you're seeing this imbalance there. And I will tell you, these guys usually win that war. So I would be very shocked over the coming weeks, maybe even months, if we don't see bonds rally, as these guys have to cover their shorts and these guys start to reduce their longs into a bond rally. So that's what we expect. We'll have to see what happens after that, and we'll go from there. Let's look a little bit about real assets. We're keeping it pretty simple in our real assets for clients. We're holding gold, we're holding gold miners, we've held some oil, and we'd like to hold some more. Other than that, we're not holding very much. Hey, gold had a good year. It depends on your timing, but certainly in 2016, gold ended the year up 8.5. Silver ended up about 15 or so. Most people remember this, which was the 3-year decline in gold. We think gold bottomed. We've made that pretty clear for clients at the beginning of 2016. It came out of the gate strongly. Of course, it corrected strongly, and starting 2017 in a good way. But it was a good year for gold. This chart shows you a little bit about where we are. So here was the rally in the new year, the correction, and so far in 2017 we're seeing a nice rally off of these oversold conditions. Again, we expect to see it kind of embed itself up here a little bit. Then we'll have to see where we go after that, similar to bonds. There have been a lot of questions and concerns around gold and rising interest rates. I will tell you, statistically, it's not something to worry too much about, because statistically gold has done very well during rate hiking cycles historically. There's been 11 rising rate cycles since 1971, and the average gain through all of them was 27%. The S&P only averaged a 2 to 3% gain over those rising rates. So maybe our concern in a rising rate environment is misguided. Maybe we should be more concerned about how equities are going to perform in that world versus gold. In the majority of the rising rate cycles, 6 of these where 11 rallied. It was a staggering amount, 61%. The other 5, it did lose some ground. So it wasn't perfect record, but very, very strong. The gains can be strong. In particular, the gains are great. Gold tends to do well when gold is coming off a secular low, kind of like it has been now, and when the rate hikes were very gradual. And right now, they look like they are going to be gradual. So not too concerned there. The miners have also been a place we've been invested for clients. We've commented a lot about this. The bull market in miners tend to be really strong. You can see this one here was 1,400%, 300%. The corrections tend to be strong too. We can see the 42%, 23, 37, 34, 33, big drops during this big bull market. So we had a big rise last year in the beginning of the year. We saw about a 42% pullback, and we're starting to see a nice rally here. So far, it does look like a bull market still intact, And so far, as you can see, as we start 2017, the miners are up 28% off the lows, having a nice rally so far at the beginning of the year. We're watching oil closely. As you know, if you follow our work, we felt that oil has a lot of nice support here in the low 40s. It's been a really strong rally off of those lows. This chart is actually very supportive. It looks like an inverse head and shoulder. We expected, as this chart points out, to try to reach up into the 60s and get overbought before we had a real correction. However, I will point out one thing that has us concerned, and it comes back to those commercial banks again. They are loading up on shorts here. So the commercial banks are actually positioning themselves bearishly for oil. Something to watch. Speculators are massively long. I'm sorry, these are the commercial banks are short. The speculators are massively long. Again, similar to bonds, usually these guys tend to be right. So the commercial banks, if we see oil start to decline, they'll cover their shorts, and these guys will be selling their longs, and that may be a better buying opportunity if we see that unfold. So we're going to keep our eye on that. And again, this may all coincide because we mentioned earlier in our commentary that we expect stocks to have a pullback, and stocks and oil have been moving hand in hand here, as you can see. So if oil were to pull back a little bit, stocks may pull back just a bit as well. So keeping an eye on that. Commodities have had a nice year, kind of under the radar. Commodities struggled for quite some time. As you can see from this chart, commodities, broadly speaking, had a pretty good 2016. We do look like the broad commodity sector is rallying, and that's not all that surprising considering they did so poorly for so many years that it's not a shock that we would see a rally in commodities. We've seen that before, where the worst performing asset rallies up and becomes the best performing asset, and maybe the best performing asset starts to decline and become the worst performing asset. The last asset class we'll take a look at are currencies. Our views have been pretty clear. We felt that the dollar, which had been in a very tight range for some time, was more likely to decline. Well, that hasn't happened. You can see it actually broke out of that range. It looks like it wants to retest the top end of that range here. We're going to be watching for that. It is certainly overbought, needs to work its way back down, as you can see. But certainly the Trump administration changed the tune and saw the dollar just rally strongly out of the box, if you will, the range. I will tell you, a stronger dollar in this environment is probably not a good thing. It will likely become a headwind to corporate earnings. We'll have to keep an eye on that. This is a chart we've shown you many times. This is the dollar in blue and the euro. Huge gap here with the euro declining and the dollar surging. Every time we've seen this in the past, they've come back towards each other. I still believe that's going to happen, where the euro is going to rally and the dollar is going to pull back. We just have to wait and see how that plays out. The yen has been a major player here. You're seeing a massive decline in the yen. This is an inverse chart, so this is the dollar yen. As the dollar versus the yen surges, you can see we're at a very important juncture here. Massively overbought. Certainly looks to us like the yen needs to rally, meaning the dollar would decline. Maybe pull this back, get this a little bit oversold, bring this back down. That would be something actually be very good for gold, probably cause a bit of a correction in the markets, but we're keeping an eye on the yen for sure. So there's a whole lot going on, and let me also put this chart up there. This is for our compliance department, the always needed fine print. And then finally, again, this is where you can reach us on the morning roundup. Reach out to us. There's a lot of positives as we head into 2017. I hope that the commentary gives you that perspective that even though we may be a little bit ahead of ourselves, we believe that we're going to be moving towards a little bit more economic growth, which we think will generally be good for the American people, good for the markets, and in time, we'll have to see how that's going to impact other assets and how the Fed may get involved, like the dollar and the bond market. We'll keep you posted in the morning roundup every single day. And as always, feel free to call or email with any questions. Thanks for your time today.